Welcome, everyone, and thank you for joining us today for a short update following Pangea Risk's Africa Elections webinar, which we released on the 8th of October. And of course, a warm welcome to you, Robert Besseling, our CEO here at Pangea Risk.
Hi, Gabby. Good to join you.
Great to have you. Now, at Pangea Risk, we've been closely following elections in Cote d'Ivoire, which took place on the 25th of October. Now the results are in, and President Ouattara has secured another term in office. Today, we'll discuss what this means in terms of President Ouattara's political strategy, how the opposition is repositioning, and most importantly, what this all means for investors as Cote d'Ivoire looks toward another growth phase. So let's get started. Now, the 25th of October election delivered a very clear result and reinforced Cote d'Ivoire's image of political stability. But beneath the surface, there are questions around succession and party dynamics, particularly in the longer term. Robert, how do you interpret the result politically, and what does it tell us about President Ouattara's longer-term plans and the RHDP's internal cohesion?
Thank you, Gabby. I think, first of all, let's take a step back because I think it's important to put things into context here where African elections really do matter when it comes to country risk forecasting. Other parts of the world, arguably far less so, but in Africa, time and again, electoral cycles show that there is a commercial impact. Now, that can go either way, and it's very easy to overestimate the impact that an election has on country risk. And we need to be accurate and commercially relevant in these forecasts. At Pangea Risk, we've developed an election vulnerability factor assessment, which looks at all the elections across Africa, Middle East, and Asia for 2025, and also for the next 2 years, 26 and 27. And that assesses the short-term impact of disruption, civil unrest, any policy discontinuation around the time of the actual election, and simultaneously then forecasts the actual impact an election will have on a country's outlook beyond that electoral cycle. It's positive, negative, or no change at all. Now, for Ivory Coast, this has gone pretty much in terms of how we said it would go. At the beginning of the electoral cycle, there were lots of indicators suggesting that there could be extensive military unrest, civil unrest, disruption to the electoral cycle and the economy. And as those indicators started to change over the past 3 or 4 months, it became clear that the election actually would pass off relatively peaceful and have a concrete result. Hence, we are seeing almost 90% of the electorate voted for, or let me rephrase that, 90% of the participating electorate, Gabby, actually voted for President Alassane Ouattara. But that, still is very much focused on the north of the country, voting overwhelmingly for the president, and many people in the south of the country voting for the opposition or not voting at all. And instead, that's actually where, if you look at the map of Ivory Coast, you see most of the unrest that happened at the time of the election and in the lead up to it. So it's in opposition areas of Abidjan, but also in the southwest and south central areas of the country, and we've seen most protests. But to be quite honest, this election passed off far more peacefully and stably than originally the indicators were showing. So it's a good example in terms of the value of indicator-based forecasting and the analysis, the methodology that we use to try and track the commercial impact on elections, Gabby.
Well, thank you. Thank you very much for that. And I'm also aware that Pangea Risk's indicator-based methodology has recently been peer-reviewed and has received some really positive feedback from the market. So it really is a test to how strong our methodology is. Speaking of the market, from a market perspective, political continuity is often welcomed, particularly if we look at a country where its investment in longer-term projects, infrastructure, industrial investment have really been the drivers of economic growth. But investors are also watching for signs of policy evolution and fiscal discipline, as particularly as global conditions tighten as they have over the course of 2025. How do you see the election outcomes shaping investor sentiment and economic priorities over the next year, especially around fiscal policy, debt management, and the private sector's role in Cote d'Ivoire's growth?
It's the key question. Absolutely. There's a lot of commercial interest in the Ivory Coast. It's a Eurobond issuing country. There's a buoyant and resilient economy driven by an increasingly diversified economic base. And there is an opportunity for further borrowing by the sovereign and to encourage private sector participation. Now, the economy should be growing for about 6.3% in 2025, and more than likely closer to 6.5% for the foreseeable future, making it one of the fastest growing economies in Africa and, in fact, in the world. That is underpinned by the economic and fiscal reforms carried out by the 3 terms so far of the Ouattara presidency, and will likely be continued going forward over the next few years. Now, that is an increasingly diversified economic base, Gabby, and it's always been said that cocoa production underpins the Ivory Coast economic model, but increasingly it's also about Italy's Eni. It's finding more and more commercially viable oil and gas reserves offshore the country. We are seeing Canadian and Australian mining houses moving towards production on gold mining assets and other critical metals that the Ivory Coast has. So all of this is really driving an economic image for the country that is attracting more and more private sector participation, and is encouraging the government to start borrowing more again in order to build out the infrastructure necessary for the economic resilience of the country. So we are going to be seeing more borrowing by the Ivorian sovereign, but in the context of a prudent fiscal outlook, a sound debt management policy, where the IMF recently came out and said that the fiscal deficit should shrink to 3%, where debt servicing costs are perfectly affordable under the current circumstances, and where the key export generating sectors are all essentially looking towards a sound fiscal base. Must briefly mention that the fallout between the Sahelian states and the Ouattara presidency is a cause for concern, Gabby, in the security context. We are seeing increasingly more and more Islamist militants crossing the northern border into Ivory Coast. And also we are seeing, because of the poor communications and relationship between the Sahel governments and the Ivory Coast, a fallout between these governments, and actually seeing militias aligned to Burkina Faso's government and other Sahel states also making incursions into the Ivory Coast. So this is certainly a cause for concern going forward. But in terms of the outlook for the country, we are very positive. We were cautious around the time of the election cycle, which we've seen in terms of our comparative risk ratings. But over the next few months, we will likely see the risk rating outlook for the country going back to where it was a year ago. Far more benign country risk outlook for the Ivory Coast coming up, Gabby.
Well, thank you, Robert, for providing an overview of Pangea Risk's latest outlook for Cote d'Ivoire. But before we wrap up, not to put you on the spot, but a quick detour to Cameroon, who, of course, also held elections this month, and where long-serving leader President Paul Biya has secured another term amid reports of some post-election unrest. Just a quick one from you, Robert. How do you assess Cameroon's near-term stability outlook, and what might this mean for its investment climate heading into 2026?
Very cheeky. I somehow knew you were going to use the opportunity to ask about Cameroon, Gabby. It's another great example of where our forecasting methodology was accurate. Because Cameroon's election, unlike the Ivory Coast's, we are seeing a far higher risk of short-term disruption, which is visible in our vulnerability factor for the country. And at the same time, even beyond the electoral cycle, everything is now raising question marks around long-term succession planning, or a lack of long-term succession planning, driving insecurity risks, driving policy continuity concerns. And that's we're seeing already immediately after the elections. We're seeing the opposition rejecting the results, foreign partners raising concerns around heavy-handed security crackdowns on protesters, and a lack of certainty to the extent to which Paul Biya will actually be in control of the centralized power structure in Cameroon. So unlike the Ivory Coast, coming out of this electoral cycle, where the risk rating will improve, for Cameroon, we're expecting a consistent deterioration of insecurity, political and economic and fiscal factors. And that all is building into our more cautious risk rating outlook on Cameroon. But can I just mention Cameroon? On Cameroon, Gabby, can I just turn this around? Because obviously you have recently done quite a bit of work on the advisory side. And can I ask you, in terms of Cameroon's post-election environment, do you think that it aligns with the broader patterns that we have seen in some interesting consulting work that you have done for some of our clients across Central Africa, and particularly in terms of the investor risk appetite heading into 2026?
No, I thought I'd get away with just asking the questions today. But it's a really fair point. I mean, obviously, we have our Insight platform where we provide country risk outlooks, but we also do tailored work with our clients as well. And I think that's really where we get a sense of their appetite, what investors are thinking when it comes to Africa or the other markets that we cover. I think in general, investors are primarily looking for continuity and predictability. And in some sense, with certain country risk factors, the post-election outcome in Cameroon does offer some short-term reassurance in that we haven't seen a leadership change at the top. But as you mentioned very clearly there, this is less guaranteed as time goes on. And we've been supporting a number of clients through that exact challenge, helping them navigate the longer-term policy uncertainty, the longer-term leadership risk within Cameroon, to identify where continually we can actually see where continuity will remain and where this would translate into an investable environment. And what we've seen across our recent advisory work in Cameroon, but I think in Central Africa more broadly, is that the absence of a credible succession plan quickly erodes investor confidence. And in Cameroon's case, I think stability will still depend on long-standing political structures rather than institutional renewal. And because of that factor, it is going to drive hesitation among investors. So without that clear roadmap for a leadership transition, a clear roadmap for reform delivery, we're likely to see capital remain cautious, favoring perhaps shorter-term exposure rather than long-term commitments as we head towards 2026.
Very good points. Thank you.
Well, thank you, Robert, and thanks everyone who joined us today. I think as we've heard, both in Cote d'Ivoire and in Cameroon's election, really, it does reinforce a sense of leadership continuity, but perhaps very importantly, highlights questions around succession, governance, and policy direction. And of course, at Pangea Risk, we will continue to monitor these dynamics very closely and keep our clients informed through our regional forecasts and bespoke updates. Thank you again for tuning in, and we look forward to seeing you in our next session.